How to improve win rate as a crypto trader. Many traders argue about the importance of win rate. While profit remains the primary goal, a high win rate can be a confidence booster, especially in the face of volatile market trends. So, how can you increase your win percentage in crypto trading? Let's go through the steps in depth. 1. Deep analysis. Don't just click. Before executing a trade, imagine yourself as a detective solving a mystery. What are the compelling reasons behind your decision? You don't want to get caught up in click action just because you're emotionally triggered or see a momentary price movement. Case in point, let's say Bitcoin suddenly rises 5% in a day. A beginner trader might be immediately tempted to buy. However, an experienced trader would ask, what caused this increase? Is it because of big news, e.g. Bitcoin ETF approval, or is it just a temporary pump? Does the trading volume support this rise? High volume usually signals the strength of the trend. If volume is low, the rise could be market manipulation. What is the current market sentiment? Check social media. Is the community upbeat, or is it worried about a correction? How to apply deep analysis. A. Combine 3 types of analysis. Don't rely on one method alone. Combination analysis is the key to seeing the full picture. 1. Technical analysis. Study chart patterns such as head and shoulders, double top/bottom. Use indicators such as RSI to spot overbought/oversold or MACD to identify momentum changes. Example, if the RSI shows a value above 70, overbought, the price may go down. 2. Fundamental analysis. Fundamental analysis. Evaluate the coin project. Is the development team credible? Does the product have real utility? Check the white paper, roadmap, or strategic partnerships. Example, if an altcoin has just partnered with a major fintech company, this could be a catalyst for price increases. 3. Sentiment analysis. Monitor trending topics on Twitter, Reddit, or crypto community platforms. Watch out for FUD, fear, uncertainty, doubt, or FOMO, which can trigger volatility. Example, if Elon Musk suddenly tweets about Dogecoin, prepare a volatility anticipation strategy. B. Think upside down. Challenge your assumptions. In trading, overconfidence is a trap. Before executing a trade, do this exercise. 1. Ask yourself, what could make my prediction wrong? Example, you believe the price of Ethereum will rise because of the bullish flag pattern. But also check, is there a strong resistance level above it? Is the market being affected by macro news, e.g. central bank rate hike? 2. Prepare for the worst-case scenario. For example, if the price drops 10% after you buy, what will you do? Set a stop loss to limit losses. 3. Avoid optimism bias. Don't just look for information that supports your opinion. Also read bearish analysis or criticism of the asset. Keywords, patience and discipline. Deep analysis is like the foundation of a house. The sturdier it is, the more resistant it is to market storms. Don't rush. It is better to miss an opportunity than to enter the trade unprepared. Hands-on practice. Make a checklist before trading. 1. Are the technical signals clear? 2. Are the project fundamentals solid? 3. Is the market sentiment favorable? 4. What is the biggest risk? With these habits, you not only increase your win rate, but also reduce costly impulsive decisions. Remember, trading is not about luck, but preparation. 2. Fight FOMO. Don't go with the emotion. FOMO, fear of missing out, is like a tsunami that can wash away your trading logic. When the price of Dogecoin shoots up 300% because of an Elon Musk tweet, or a Shiba Inu suddenly goes viral on TikTok, the temptation to jump on the bandwagon is great. But remember, impulse trading is a shortcut to loss. Why is FOMO dangerous? You're buying at peak price. When an asset goes viral, the price is often overbought. Example, when Bitcoin hit an ADH all-time high of $69,000 in 2021, many traders FOMO bought at the peak, then got stuck when the price dropped 50% within a few weeks. Emotion trumps plan. FOMO makes you ignore your risk management, stop loss, or entry criteria. Strategies to beat FOMO. A. Establish strong entry criteria. Create rules that are specific, measurable, and difficult to manipulate by emotions. Example, technical requirements. I will only buy if 1. The price is above the 50 EMA to confirm a bullish trend. 2. 24-hour trading volume rises by at least 200%, sign of large participation. 3. RSI below 70, avoiding overbought. Fundamental requirements. I only invest in coins that already have a live product, transparent developer team, and clear roadmap. Case example. When Shiba Inu suddenly rises 500% due to rumors of burning tokens, disciplined traders will refuse to enter unless volume and technical indicators support. If the conditions are not met, let the opportunity pass. B. Verify every suggestion instantly. Crypto influencers are often like salesmen. They create urgency for you to buy quickly. Don't fall victim to the hype. Ask these 3 things before following a recommendation. 1. Do they have proof of transaction? Many influencers only talk, but never show a real portfolio. 2. Is their analysis supported by data? If someone says XYZ coin will pump, check if there are bullish chart patterns, rising volume, or fundamental news. 3. What are their motives? Are they getting paid for promotion? Check for ad or sponsored hashtags in their posts. Example. A YouTuber recommends buying Coina because it's going to a big exchange. Before jumping on board, check the exchange's official website. Is there an announcement? Monitor the trading volume. Is there a significant spike? C. Mental training. Pause 5 minutes. Before clicking buy, pause and do this. 1. Take a deep breath. Keep your hands away from the mouse/keyboard. 2. Reread your entry criteria. 3. Ask yourself, do I want to buy because of analysis or because I'm afraid of missing out? Example. When you see a Telegram group discussing CoinB will moon tomorrow, pause for a moment. If your entry criteria are not met, say, not for me. True story. Learning from FOMO mistakes. In 2021, many traders were FOMO buying Squid Game token, Squid, because of the Netflix series hype. The price went from 1 cent to $2,861 in 3 days. However, the project turned out to be a scam. The developers blocked the sale, and the price dropped to $0 within minutes. Lesson. FOMO without research equals playing with fire. Assets that rise too fast are often too good to be true. Keyword. Discipline or go bankrupt. FOMO is the biggest test of a trader's mentality. With clear entry criteria, data verification, and patience, you can become a 5% consistently profitable trader. Remember, in the crypto market, opportunities always come again and again. Don't be afraid to miss a gem. Focus on your own plan. Bonus tip. Turn off price notifications. Avoid constantly checking the price. It triggers emotional decisions. Create a blacklist. Write a list of coins that are too speculative/risky. Example. Meme coin without utility. 3. Focus on the mainstay. Don't be greedy. In the world of crypto trading, greed is often more dangerous than analytical errors. Many traders fail not because they lack knowledge, but because they can't stick to their own strategy. They are like chefs who keep changing their signature recipe just because they see someone else's dish looking good. In fact, mastery only comes from repetition and discipline. Why is master strategy important? 1. You master certain market patterns. Every trading strategy has its own ecosystem. Example. Scalping in volatile markets requires speed and understanding liquidity levels. Swing trading based on chart patterns requires patience to wait for confirmation. If you keep switching strategies, you'll never truly master one area. 2. Reduced risk of emotional mistakes. When you focus on one method, you have a clear protocol for entry, exit, and risk management. This reduces impulsive decisions. 3. Builds accurate instincts. Like a chess player who knows his opponent's moves by heart, a consistent trader will easily recognize repetitive patterns in his strategy. Example. If you are a master of breakout trading, you can hear the sigh of volume before the price breaks the resistance. How to build and maintain your strategy. A. Find your comfort zone. Experiment early. At the beginning of your trading career, try different strategies, day trading, position trading, arbitrage, etc. Record the results. Which strategy is the most profitable? Which one suits your personality best? Are you the patient or agile type? Specialization example. If you find your passion in new listings, focus on 1. Monitoring listing platforms, Binance Launchpad, Coinbase, OKX. 2. Studying the price patterns of new coins. 90% of new coins experience a 50 to 100% pump within the first 1 hour of listing. 70% of coins experience a 30 to 60% correction within the next 24 hours. 3. Create rules. Take profit at 50% of the initial increase, and never hold a new coin for more than 6 hours. B. Fight the temptation of the great strategy. Many traders are trapped in a circle. 1. See people profit using strategy X, follow, fail because they don't understand. 2. Switch to strategy Y, fail again. Solution. Make a covenant with yourself. I will not try a new strategy for 6 months unless there is evidence of a consistent backtest for 1 year. Honestly analyze loss. If a reliable strategy suddenly fails, ask, is the market out of whack, e.g. sideways when you're using a trend-following strategy? Did you break your own rules, e.g. entered without volume confirmation? C. Discipline in sideways markets. Silence is a weapon. The crypto market is not always active. When it's sideways, novice traders are often desperate to trade just because they have an itchy hand. Case in point, Bitcoin moves in the $29,000 to $30,000 range for 2 weeks. Trader A, breakout expert, chooses not to trade until the price goes out of the range. Trader B, undisciplined, forced a short at $29,800 because he expected the price to drop. But the price breaks out to $31,000, and Trader B gets a margin call. Lesson: not trading equals staying profitable because you don't lose. Utilize sideways time to review the trading journal. Learn new patterns without changing the main strategy. Success story: traders who are faithful to one style. A trader on Twitter at Crypto Snipers only focuses on the retest after breakout pattern in Bitcoin. His rules: 1. Buy when the price retests the breakout level with high volume. 2. Stop loss 2% below the retest level. 3. Take profit 1 to 2 risk-reward ratio. The result? In 18 months, the win rate was 68% with a consistent profit of 15% per month. The key: he rejected 99% of trades that didn't meet his criteria, even though the community was talking about magic altcoins. Keyword: perfection variety. Mastering one strategy is like sharpening a knife until it is very sharp. Instead of having 10 dull knives, it is better to have one that can cut through anything. Final tip: create a mandatory checklist before trading. Example: 1. Does the signal match the main strategy? 2. Is the risk-reward ratio at least 1 to 2? 3. Am I emotional, happy/sad? If any of the above conditions are not met, then do not trade. Write on sticky note: if my strategy is not working, I will improve, not change strategy. Remember, greed kills more traders than bear markets. Stay faithful and let time prove the superiority of your winning moves. 4. Reduce frequency, quality over quantity. Many traders are trapped in an illusion. The more you trade, the richer you get. In fact, the reality is quite the opposite. Overtrading is a poison that eats away at common sense and profits. When you make 20 trades in a week, chances are that half of them are emotional decisions that are not scalable. Why is high frequency dangerous? 1. Mental fatigue. Trading is a focus-draining activity. The more frequently you open positions, the higher the risk of burnout and analysis errors. 2. Cumulative costs. Every trade has a cost: transaction fee, spread, slippage. If you trade 10 times a day at a cost of $10 per trade, you've burned $2,000 in a month. Not necessarily profit. 3. False opportunities. Not all signals are worth taking. The crypto market is full of fake breakouts, pump and dump, or random noise. Trading recklessly will only drain your capital. The less is more strategy. Focus on quality trades. A. Filter signals roughly and strictly. Imagine yourself as a gold sifter. Take only the valuable grains. Discard the useless pebbles. Minimum criteria for trade execution. 1. Volume confirmation. Volume should be 2-3x the daily average. Show real market participation. 2. Alignment with strategy. Does this signal align with your strategy? If you're a breakout trader, don't be tempted to reversal just out of boredom. 3. Risk-reward ratio of at least 1 to 2. If the risk of loss is $100, the potential profit should be $200 plus. Case example. You see Bitcoin approaching the $106,000 resistance. Before execution, has the price closed above the resistance with a strong candle? Has the volume increased by at least 150% of the average? Is there any positive sentiment, e.g. Bitcoin ETF news approved? If any of these are not met, skip. B. Prioritize rationality, kill impulsivity. In front of the screen, emotions can change like a roller coaster. Discipline is the best shield. The 5 whys technique before clicking buy sell. 1. Why do I want to take this trade? Because of the price breakout. 2. Why is this breakout valid? High volume and a confirming closing candle. 3. Why does the risk-reward ratio make sense? Stop loss 2%, take profit 4%. 4. Why am I sure I'm not being FOMO? I've verified the data, not following the crowd. 5. Why is this trade portfolio worthy? It meets all the checklist criteria. If all answers are logical, execute. If in doubt, cancel order. C. Utilize dead time for learning, not trading. When the market is quiet or sideways, don't push yourself. Silence is a strategy. Productive activities in leisure time. Analyze old trading journals. Learn patterns of repeated mistakes. Backtest strategies. Test the effectiveness of a winning move in different market conditions. Research new projects. Read white papers. Monitor developments in blockchain technology. Example. When Ethereum stagnates at $1,800 for a week, a wise trader will use the time to study the Ethereum 2.0 update. Build a watch list of coins with strong fundamentals. Fine-tune risk management for the next trade. Sample story. A winning trader with 3 trades per month. A trader named Rainer Teo, quoted from his book, only made 3 to 4 trades per month, focusing on high-probability price action patterns. The result? A 65% win rate with consistent annual profits of 30 to 40%. His key to success. Only take trades with confirmation of strong support/resistance levels plus abnormal volume. Doesn't care about missed opportunities. He believes opportunities always repeat themselves. Closing, consistency is key. Increasing win rate is not about being a superhero who catches all opportunities. It's about being a clever goalkeeper, only letting quality goals into the net. 3 final principles. 1. 10 quality trades greater than 100 origin trades. Calculate profit from quality, not quantity. 2. Trading journal is the best teacher. Record every decision and evaluate it weekly. 3. Be patient with the process. Like an oak tree, a solid win rate takes years. Remember, life-changing trading is a marathon, not a sprint. By reducing frequency, choosing premium trades, and staying disciplined, you'll not only increase your win rate, but also build a winning mentality that's ready for any market. The stock market, or crypto, is designed to transfer money from the active to the patient. Warren Buffett, the same principle applies in crypto. Okay, before we end, don't forget our golden rules. 5 important rules of Mr. So Crypto. First, don't use hot money. Use extra or idle money. Do not use money for daily needs or money that will be used in the near future. Second, don't over-leverage. Risk what you can afford to lose if you trade derivatives, futures. Always use a stop loss because the crypto market is very volatile. Third, 70 Bitcoin 30 altcoin. Always allocate more in Bitcoin because Bitcoin is the parent of crypto. By allocating more in Bitcoin, your portfolio will be safer when the market does not meet expectations. Fourth, always stay cash. Always stay in cash 10 to 20 to buy when the market discounts or drops significantly. Then you can sell when the price has risen so that you still have cash for the next discount. Fifth, think long-term. Investing is not about 1 or 2 days to get rich. So think long-term and minimize the risks that might make your money disappear. Everything takes time. Remember, Warren Buffett didn't build his fortune overnight. If you find this video useful, help us to continue to make videos like this by clicking subscribe and share with your family and friends. Don't forget to let us know in the comments column if there is anything you have questions about, because your comments mean a lot to build this channel. See you soon, and don't forget, HODL knowledge and mindset first, then HODL assets.